Well, here we are again. Good morning. It's Tuesday, 2 weeks after the Melbourne Cup, and the horse race was less auspicious than perhaps the historical rate cut by the RBA, as everyone has been talking about. So I hope everyone's had a great time since last week. We're here for our Q&A. It's live on Facebook, and we're here via Zoom. So please take the opportunity. If you want to send in any questions, do so. We'll then look at those. If we don't have time to cover them today, we obviously take them into our question bank, and we will cover them off either next week or the week after. But we'll certainly let you know, and happy to come back to you on an individual basis as well if you need some more help in the meantime. Today I'm going to have a look at a couple of interesting things. One's a real life situation that occurred just a few days ago. It's a client of ours. He's an expat and he wants to buy a holiday home on the New South Wales south coast. Lovely part of the world that it is, but his accountant has advised him that he should buy this in his family trust. It's a discretionary trust. He's married, they have a blended family, they have adult children. So, it throws up some interesting things. And you've got to ask yourself a lot of questions before you go and charge off and put someone's name on a contract of sale, because you may not be able to change that. So, as I said to him, look, you need to ask yourself some questions. And one of the main ones that came out, of course, is, as most people should know, even if they don't, that there are some real major changes afoot, and the time frame left for amending discretionary family trust deeds is fast running out. We have until the 31st of December this year, 2020. If you have a family trust deed that either holds property in New South Wales, is going to buy property in New South Wales, or you just don't know, it would still be a great idea to make sure that the amendments to your trust deed are signed and registered before 31st of December this year, because if you don't make any specific amendment to your trust deed, Revenue New South Wales is going to consider your family trust a foreign trust for land tax purposes and for stamp duty purposes. And as I said to our client, that's a major item. So I asked, when did your family trust deed get established? And he said, a few years ago. I said, well, has it been amended? And he said, what are you talking about? I'm not a foreign person. And I said, yeah, I know that. You're an Australian citizen, your wife's an Australian citizen, the children are Australian citizens. The fact that you're an expat, a non-resident for tax purposes, doesn't change that. However, if you don't amend your trust deed to say that in future a foreign person can never be a beneficiary of that trust, then the authorities will deem it to be a foreign trust as of 1st of January next year. You might go, so what? Well, it actually is pretty important, because if you own land, then you're immediately going to be taxed with the surcharge rate of 2% of the value of the property for land tax. If you're going to buy property, it's an extra 8% stamp duty. And the same goes for a lot of younger clients that I find we have, where they may have been advised for whatever reason to get a discretionary trust or a unit trust with a corporate trustee and go and buy property with that in New South Wales. I just want to make sure that everyone's aware that they need to have this amendment put in place, unless they want to be paying a lot of needless extra funds out for nothing. And by the way, the land tax rate goes up when you get to the premium level of 4,488,000. So that's important. But then for this person who wants to buy a little holiday home for $900,000, what are the other issues? What are the benefits of owning it in a family trust, and what are the benefits of not doing so? Well, one of the problems in New South Wales is that for getting this amendment, discretionary family trusts don't get the land tax threshold. So, at $734,000 this year for 2020, that's a lot of money. That means your trust will then be paying land tax from $1 at 1.6%. Whereas if you say had bought that property in your own name as an individual or in joint names with your spouse, you would clearly not be paying that land tax at all, because you'd be under the surcharge, because the land value relates to the value of generals, indicative land value that gets updated every 3 years. So another massive thing that you need to consider. And then, this is a holiday home, so what's the likelihood of you wanting to sell this and then distribute some hypothetical massive potential gain out to beneficiaries? It may be really low. You may be able just want to keep this place for a long time, make improvements on it, and use it as your holiday home when you repatriate to Australia. So, the whole situation of setting up all these other accounting boxes and legal entities to do something that may be somewhat foolhardy to start with becomes even worse as time goes on. And if you think about it, if you own something like this for 10 years or 15 years or 20 years, the amount of extra money you're paying to the government for no reason becomes extremely large. So anyway, that's a great tip, I think, for all of our clients to remember. And the other thing that's important to think about is if you're making a will, that testamentary trusts will also be caught up with this foreign person amendment if they're created after the 31st of December this year. Again, I would recommend that you speak to your lawyer. If not, we have a great panel of really good professionals we can point you to if you need some advice, some assistance with that. Please reach out. It's something that a lot of very knowledgeable people actually don't know about, and once the time's gone, you can't amend these things. So keep that in mind. Pardon me. So the other things you've got to look at, I suppose, is also from a lending viewpoint in terms of how much you can borrow. Generally speaking, it's far easier, especially as an expat, for us to secure a loan from you from a bank at a very favourable rate if you're borrowing as an individual rather than using a corporate trustee. It shouldn't be that way, but it generally is from a practical viewpoint. So they're one of the other important things to bear in mind. Unless you're paying cash for this property, then keep that in mind. So look, lots of things there. I just wanted to share that with you because there's so much important stuff happening within that whole subset of circumstances. And people get this, in many different ways. You might be looking to buy a house that you wish to subdivide and then build perhaps 2 new dwellings on that, and you're thinking about distributing capital gains from that. So it's really important to look at how this particular ruling will impact you as an individual and your circumstances, and if you're going about it in the right manner. And we find that quite often with younger clients who are looking to go down the track of perhaps developing properties. This is a really important issue for them as well. So don't try and overcome everything. Try and be sensible in your approach, and you'll always generally end up with a better outcome anyway. Trying to simplify things in life, I find, is actually the difficult part. Trying to make them complex is pretty easy. People can throw complexities at you from all sorts of angles. Legal complexities, accounting complexities, tax complexities. And at the end of the day, it's more about trying to take all that in, and we try and help people simplify that. Simplify your financial lives, and you're so much better off, and generally end up with a far better financial and commercial outcome too. So, the two things don't go hand in hand. It's really important. Keep that in mind. The other question we've been getting through the week is in relation to, I guess, what people feel they need to do now that the RBA has cut rates to 0.1% and has embarked on its QE, on its quantitative easing measures. So people are saying, look, I've got loans at the moment, I've got investment properties, I'm wanting to buy another one. Should I fix my rates now? Because I've had a look, and most banks haven't actually done anything to reduce their fixed rate loans for investment properties. Most of them have done something on the owner-occupied lending side of things, be it variable rates or be it fixed rates for mainly principal and interest repayments rather than interest-only repayments. But there's been a great deal of sort of movement at the station in that space, but virtually none for investment loans. So again, my answer would be, well, let's have a look at it. It depends. I'll just have a look at some of these things here, but it depends on many things. And we're here to sort of go through that, and I always ask people questions because that's how you get the right answers. And one question would be, well, how much cash flow does a property generate? Is it currently, at a high level of indebtedness or at a low level? If you're an expat, as we all know, rental income is ATI, Australian taxable income, and we pay tax at 32.5% in the dollar from $1. So important to try and make things as neutrally geared as possible, I think, if you can. And in most instances, that's certainly possible. And then you want to have a look at, what's the differential in rates between variable rates and fixed rates. And that can be still quite significant in this environment, in this current new low rate world that we're living in. And it looks like we'll be living in it for a fair bit longer too. So important to consider what your priorities are. If this property that you own may become your main residence when you repatriate to Australia, then a principal and interest situation may well suit you best. You may want to pay down the debt outstanding on that property whilst you're away, so that when you go back, you'll end up with a mortgage, a non-tax deductible mortgage, so the interest won't be deductible then, that's lower than otherwise. And we can use other ways of potentially helping you turbocharge that to some extent too, if that's your prime concern. Other people might say, well, no, I'm not going to move into this property or any of my other investment properties, so it might be better for me to maintain a high level of debt on those and save up my money to put into something that I want to live in down the track, because right now I don't even know what that is. So there's another strategy that has a whole different set of circumstances that we can help you with, but it's quite different to the first one. And the main thing with all of this, I suppose, is to try and maintain as much flexibility as possible and still manage, I guess, the cost of that debt, because to me, especially in a low rate environment, debt really should be an asset, and we help people construct their debt portfolio so that it becomes an asset. And you can use different fixed rate terms. You can use 1, 2, 3, 4, 5 year fixed rate terms, and they can be employed for a single property or a number of properties. And then you can have a variable component with that, where you might want to have an offset facility in case you want to pay down some of that in terms of putting cash in to offset the debt outstanding, but still have a facility in place for later on if you need to. And you can always then just withdraw those funds from your offset account and potentially substitute security of, say, a new main residence that you might want to buy in the future. We help clients with that regularly, and it's something that most people, again, don't know about, don't know how to go about it, and find difficult if they ask their bank, because perhaps the explanation goes a bit awry along the way, but no one knows exactly what to do. So, it really, look, as I say, it depends. No one has a crystal ball. Are banks going to drop rates on investment loans? Who knows? They're not doing so at the moment. They should, but banks again look at where they source their funds. So in the swap markets, perhaps rates aren't moving because banks have more control over how much they pay depositors in terms of the interest that they're paying out on those deposit funds that people are putting in, and so they can reduce that. And as we're seeing now, if you're putting cash on deposit with a bank, the amount that you're getting is so incredibly small that it seems almost ridiculous. And that's what you've got to weigh up. So I think there are lots of ways of doing this, and now perhaps is a good time to use an offset account to put money in, so at least you're getting essentially the same rate of return as the interest component. So if the interest is 3.5%, let's say, effectively by putting money into that offset account and you're not paying 3.5%, you're getting 3.5% for your money in a roundabout manner. So these are all the things we have to look at. But at the end of the day, I think fixed rates are more important than just trying to pick a low point in the market. Obviously, that's helpful. However, they're designed to give you peace of mind. So you then have a regular cash flow component to your interest rate expense. And say you fix that for 3 years or 4 years or 5 years, that's quite a long time for you to know that you've worked out that, let's say you're paying 2.5%, you can afford to pay that comfortably over that period of time, and if it goes down to 2%, so be it, and you miss out on that reduction. You have the benefit not only of having that peace of mind for a considerable length of time, but what if it goes up that 50 basis points to 3%? You won't have to pay the higher rate. So I think at some point in time, and we may well be there now, you come to a situation in credit cycles where rates are extremely low and you're happy to lock in a rate for a considerable amount of time, or perhaps a shorter space. If you feel that rates are going to move significantly lower, then you might choose, pardon me, a 1 year or a 2 year rate. So you have lots of options. And what I'm saying is, if you have a number of properties and you owe $1 million, let's say, you could do a combination. You could do 300,000 fixed for 3 years, 100,000 fixed for 2 years, 200,000 fixed for 5 years, and the rest variable with an offset account. So there's lots of things you can do, and it just depends on the outcomes that you're seeking that are really important for you in your own personal set of circumstances. And we're all individuals, so everyone's circumstances are different. Everyone wants different outcomes, but quite often, once you delve into it and we ask the questions, we find out that some of those outcomes may be either not logical or counterintuitive, or maybe worse for you if you implement them, but you don't have all the information at hand, so you need to get the information. And that's why I always say, make sure you've got a good team of advisors that you can turn to help you in establishing not just what you want to do, but the practicalities that are involved with that. And I might just go back to the first question that we handled today and remind everyone, please, 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 if you have a family trust, especially that owns property in New South Wales currently or is looking to buy some, make sure you look at your trust deed and see if it's been amended so that in the future a foreign person cannot become a beneficiary of that trust. Otherwise, you could be in for a really expensive rude shock going forward. I hope this has been helpful. It's designed to help people, I guess, with different topics in a shorter, more abbreviated manner. We've had lots of other questions and I'm dealing with some people on a one-on-one basis, but we'll continue next week as we do every week and try and pick out some more interesting points to share. So please send in your questions. We'll cover them at some point. A lot of people's questions may be of a similar vein and we'll do that. And in the meantime, I hope you have a great week. Everything goes well and I'll see you again next Tuesday. All the best.